What's good, everyone, and welcome back to the Financial Freedom channel. We are on our free money glitch series number 1, talking about the first part of portfolio construction, asset classes. We will look at some of the different asset classes that are popular and learn how to invest in them. So grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go collect this money. Selecting the right combination of asset classes is an important part of any investment portfolio and is often overlooked by investors during the portfolio construction process, right? So there are two types of asset classes. There's your defensive asset classes and growth asset classes, with each having unique characteristics that determine the amount of risk and reward they can provide an investor. Now, with defensive assets, the name suggests that they have lower levels of risk than growth assets, right? The investment vehicles that fall into this category are usually fixed interest and cash based, right? Where the focus is on capital protection with modest returns. So there is no minimum time frame for defensive assets, as they provide income to investors in the form of regular interest payments. Okay. Now, with growth assets include investments with an expectation that the underlying asset will increase in value over time. Okay. So although growth assets can provide an income component, this category of assets are mostly expected to provide returns in the form of capital growth, right? So a regular share is considered a growth asset if income is received in the form of dividends on a regular basis. So capital gains can be made in times of strength, and capital losses in the times of weakness, because the share price will fluctuate according to the market conditions. So this element of volatility increases the risk of investing in growth assets, but it also helps provide the anticipated growth of the asset above the regular income. All right. And there are more investment options, in the growth category than there are in the defensive category. Okay. An asset class is a group of investments that have the same characteristics in terms of risk reward. And there are many variations of an asset class, right? So in the defensive assets, the first one is cash. The majority of cash is held at financial institutions. So cash held at financial institutions may be in an account that earns interest, but this is usually at a very low interest rates, and funds are generally accessible on call by an investor. Now, with term deposits are usually held at banks or other financial institutions where deposits are invested at a fixed interest rate for a set period of time. So although returns are conservative, investments are protected, right? And term deposits, up to $250,000 are guaranteed by the U.S. government, and longer periods of investment in term deposits attract a higher rate of return. Now, with bonds are a fixed income investment where investors loan money to corporate companies or governments up to a maturity date where the debt must be repaid, right? Bonds provide income to investors in the form of regular payments, but unlike shares, an investor doesn't have ownership rights. So any capital growth of the company won't benefit the bond holder. Okay. Corporate bonds can be bought and sold, on the exchange as well. Growth asset classes, you first have your domestic equities, right? The company shares that can be traded are, one of the most recognizable asset classes. Domestic equities provide income in the form of dividends and capital growth from rising share price. So capital growth is where the performance of shares are judged, and most investors own shares for both components. Because of the inherent nature of capital, or should I say company values rising and falling on the back of individual performances, this asset class is considered riskier than other growth asset classes. Okay. Now, with global equities, so international equities offer a variety of investment options that aren't tied to the performance of U.S. companies on a global scale. So some companies could be operating in a flat period of growth domestically, which could have a negative effect on their share prices. While international companies from different regions could be experiencing quite the opposite, right? So other industry sectors that are limited in the country may have greater representation in global markets. Okay. Now, REITs, also called real estate investment trust, REITs are companies that own and manage commercial and residential real estate, such as like warehouses, apartment buildings, shopping centers, hotels, offices. Okay. Similar to equity shares, publicly offered REITs are traded on major exchanges and generate income in the form of dividends. So the price of a real estate investment trust is determined by the value of their assets and their income. Okay. Now, with commodities are products that are bought or sold on price. Okay. Gold, silver, oil, natural gases, wheat are some of the most popular commodities for investors to trade. So although investors can technically buy and sell a physical product, the majority of transactions occur using contracts for difference, future contracts, or they call them ETFs, which stands for exchange traded funds, which are available on many, major exchanges and brokerages. Okay. An asset class is a group of investments that have the same characteristics in terms of, risk reward and perform the same in different market conditions. The three market conditions an investor can expect to deal with is your bullish market, your bearish, and your flat market. Okay. So with the bullish market, domestic and international shares are basically the stars of the show in the bull market. Bullish markets signal a booming economy and help other asset classes rise in value. Demand for commodities increases when the economy is booming. While the economy is strong, booming economies have a positive effect on real estate as well, right? Which makes sense. All things being equal, though, during a bull market, bond prices tend to decrease, right? With an increase seen in bond yields, because the appetite for risk from investors increases, right? So, as an example, in a strong bull market, equities are all the rage with investors, where a risk-off mentality sees money flow from a lower return environment inside of bonds to the lucrative returns associated with domestic and international equities. Okay. In bearish markets, domestic and international equities will perform poorly during a market downturn. So government bonds and corporate bonds perform better than equities. If a company fails to meet shareholder expectations, the price of the bond isn't affected in the same way as the share price, because owning a company bond isn't the same as owning a share in the company. The share prices of companies historically hold up well in market downturns if the company suffers a significant financial issue, right? Commodities have historically performed better than the stock market in market downturns. In the most aggressive market downturns, the price of commodities like wheat and coffee typically, they'll continue as normal, because the volume of consumption has little relevance to the share market, right? So that's why companies like Starbucks are really great long-term investments. Precious metals such as gold and silver also, can be used as a safe haven for cash exiting the share market. Okay. And then finally, in your flat markets tend to have the most consistent performance across most asset classes. The majority of stocks in both domestic and international equities markets typically are unaffected by adverse moves either way. So it's ideal for income investors who need income through dividends without significant fluctuations in the value in the value of their share portfolio, right? So commodities and bonds have a tendency to stay the same in this market condition, and in a flat market property rarely decreases in value, but the economy is generally sound. So rental incomes and leases that make up a substantial portion of REITs income are expected to remain stable or increase. Okay, so the next section will focus on how investors can access the different asset classes. There are two types of investors. There's wholesale and retail, and depending on which category they fall under, an investor can gain exposure to certain asset classes. So with wholesale investors are expected to assess proposals of security and other financial products without the protection of product disclosure statements afforded to retail clients, right? And investors classified as a wholesale client if they satisfy either of the following tests. All right, so a certificate from a qualified accountant is required for an investor to be classified as wholesale, and must be renewed every 2 years. Okay, so wholesale investors have an advantage in terms of investment opportunities due to the fact that unlisted corporate bonds and share placements are not available to retail clients, right? The primary market is where securities are created. So financial products like company and government bonds, new stocks that are sold by investment firms and initial public offerings are all accessible in the primary market. Okay, and then there's your retail investors. So ETFs, exchange traded funds, can be used in the secondary market to gain access to investments that aren't available to retail traders. So the secondary market is where investors buy and sell products. The secondary market is accessed through the New York Stock Exchange in the US. So ETFs can be bought and sold on the exchange just like ordinary shares, and they can track the underlying asset or market that they represent. The value of an ETF will rise and fall in line with underlying asset classes, and the price rarely deviates far, from other prices. So many of the more popular ETFs pay dividends, and they can give investors capital growth opportunities and rise in markets. So due to most transaction costs being, based on volume, ETFs are very effective, and they're a great way to gain exposure to many asset classes, right? Even investors with, modest portfolios have the ability to trade investments like bonds, commodities, REITs, and international equities without the need to abide by minimum levels of volume. Okay, so a portfolio as small as $10,000 could easily, be divided into 5 asset classes without the need to leverage the base to meet minimum trade sizes, right? The S&P 500 is a major index in America, and this is a great way for investors to get exposure to international markets without having to invest in individual companies. Okay, so although some products are restricted to only wholesale investors, the opportunities for retail investors to build a portfolio with a variety of asset classes is very doable. Okay, so this finishes off our first section in the Free Money Glitch portfolio construction. Next, we will learn specifically about how to construct an investment portfolio and how to use asset diversification to minimize risk. Like, comment, and subscribe. I love y'all. From yours truly, Financial Freedom.